Securities. Now let's move on to the commodity space, because of course overnight we did see really a sea of green across that whole complex. We saw copper prices doing well, silver, gold prices all sort of tracking higher there, and then of course the iron ore price, a big bounce there. About 11% or so that we've seen for the iron ore price over the last couple of sessions. Let's bring in Markus Helsing from JB Markets, who's live in our Melbourne studio. Here come the commodities again, Markus. What are you making of these moves? Looks like, yeah, ready to rock and roll.
Yeah, very much so. I think, hi, Leanne, thanks for having me on the show. Look, I mean, this is really the sort of sweet spot for us to see the beginning of a major new commodity bull market, to be quite honest. It might be a relatively short one. It could be a 1 year, 2 year show. We'll find out soon enough. But I mean, before we go into details, a lot of that has to do, in our view, with the US dollar. The US dollar on the index, on the basket, is really coming off quite significantly, and we believe that will accelerate even much more into the second half this year. Now, what effect does it have on a country like China? Well, China is pegged to the US dollar, so the competitiveness of China with a weaker yuan makes it, therefore, that much more competitive globally in what they do in terms of imports and exports. In other words, this is a good news story for Australia. This is a good news story for commodities that Australia exports. I mean, takes a look on a main key commodity, copper. To us, this is a market that's consolidated beautifully and is ready for a breakup. The iron ore price action of the last 4 to 8 weeks has been very convincing in terms of finding a bottom, finding support, and coming back and snapping back convincingly. So really, we think there's a real revival happening in the commodity sector. And I mean, if you take a look at the Aussie dollar, again, we are in this 12 months range between 72 and 77 cents. I mean, to us, this looks very bullish. We still believe, and I'm saying that for the last 6 months, we still believe the Aussie belongs into the 80 to 85 cent territory based on a terms of trade benefit, which we didn't have. We believe that will change. We believe the terms of trade from here onwards into September, December this year could improve significantly. And that is obviously based on what we export, which is iron ore, coal, and our key other commodities.
Speaking of coal, and I just wanted to get you and our viewers across some breaking news that we are getting through from Rio Tinto. Of course, we've been hearing from the Rio board that they were urging shareholders to approve Yancoal's $2.69 billion offer for those coal assets. They were holding a shareholder meeting there in Sydney, and we're just receiving confirmation from Rio that shareholders have approved the coal and allied sale to Yancoal. 97% of the votes were in favour of the coal and allied deal. Now, we know that we did have Glencore's offer there as well, but Rio backed the Yancoal bid in favour over the Glencore offer there. So, as we mentioned, $2.69 billion bid for those thermal coal assets. I'm not sure if this is one that you've been watching at all, Markus, because this bidding war between Yancoal and Glencore has very much been at play there. Certainly quite a good appetite. You know, coal, as we know, has been under pressure, but there's been a good appetite there for those coal assets.
Well, it's the old saying in the industry, expect the unexpected always. And I think it does show you a bit the Chinese macro play. And I mean, as much as we all hear the press and the news about coal is bad and everything else is good, obviously there's a transition phase and we're in the middle of it. It'll probably last another 10 or 20 years. So, I mean, there's quite obvious a situation where China and India will not be able to wean itself off coal. They actually need a lot of it. So, unfortunately, if you like it or not, that's just the case. So, in essence, we're well placed for that. And we just feel this could just be the beginning of one more renaissance in commodities. We don't believe that's anything we've seen prior to the previous booms, but nevertheless, this could be a significant 12 months commodity renaissance, and I think people should take that seriously. So we're actually quite bullish on the Aussie dollar. We're now really keen to see your sort of lead commodity, which is copper in our view, to take the lead role. I think it's well placed, price-wise, technically, as well as fundamentally. With all the talk about electric cars, we'll try to build an electric car with our copper. I mean, there's a lot of indications to us that your key commodities that Australia exports are going to be beneficial. So our terms of trade will improve from here onwards. This is good news.
I I want to come back to the iron ore price, and I know that you did touch on it earlier, but a big rise that we have seen over the last couple of days, I think a move of about 10 or 11%, albeit it has been off a low base. We know it's been under pressure. Do you think it's sustainable now? Do you think we've reached a bottom and we may see a bit of momentum coming back in for the iron ore price?
Look, I think we've reached the bottom, and if we see momentum from here, we shall see. I would imagine after such moves, we've just seen recently from off the key lows below 50, and now again trading in the low 60s. Look, if we can hold between $55 and $60 a ton, I reckon it would be absolutely tremendous base for all iron ore exporters, for Australia as a whole. And after all sort of rallies of a key bottom, as we've just seen, you normally see a bit of retracement and a consolidation phase. And you really need to see the net bottom line of what's happening in China, of course. But I think that the real factor here is the US dollar, and that should not be underestimated. I mean, what actually do people do when they sell a currency, buy another? Well, they've got to do something with it. So essentially, for example, we look at Euro-US, for example. They're buying Euro and selling US. Well, obviously, they're going to do something with the Euros. So this is a positive Euro story. Now, with the Aussie dollar, that's the same thing. If they buy Aussie dollars and sell US, what the hell are they doing with these Aussie dollars? Who is buying the Aussie dollars? There's obviously a demand story there, and we believe this could be responsible for ultimately breaking the Aussie above the key 77.5 level that we haven't really broken for the last 15, 16 months. And we think this is going to happen in the second half of this year, probably in the next couple of months.
Yeah. Oh, yeah, we know that the US dollar obviously providing that support for commodities. Oil prices were an interesting move overnight as well, because they rose for a fifth day, in fact, despite those crude stockpiles. The US Energy Information Administration coming through with an increase. I think the market was expecting a decline of about 2.6 million barrels. We did see a rise, though, in stockpiles, but nonetheless, the oil price did move up, which was quite a fascinating move there. Do you think this is a case of some bargain hunting and, picking up these oil prices at these very low prices?
Well, maybe. Look, I mean, with oil and oil prices, we all ought to be a bit careful. I mean, at the end of the day, it is a cartel with OPEC. They might have a bit less control nowadays than they used to have. But the bottom line is, with this supply story, I don't think oil is going to race away from us. But nevertheless, good bounce off the key lows below $42 a barrel, based on West Texas Intermediate. We just look at certain oil stocks to give it guidance. Some actually look quite keen. I mean, here domestically, for example, Santos is tremendous value for us. I mean, it's been, everyone touted it as a geared play. Of course it's a geared play, but it also has become now, in our view, a value geared play. So there's value out there. If oil is going to run away from here, probably not, but probably do a base build between $42 and $48 a barrel, and that's good enough for the next 3 months, and then we'll take it from there.
All right, excellent. Just to finish up, grains. Love talking to you about some of these soft commodities, wheat in particular, which looks like a great value proposition.
Well, that's right. I mean, anyone looks out there, but we've hardly had any rain here in Australia. I mean, the poor farmers really are struggling already. I mean, it's looking as though we could actually facing a serious drought period again. Europe, I speak to Switzerland, my folks every now and then, some friends in Germany. They haven't seen rain for the last 3 months, basically. They have a heat wave, not seen in decades. So, look, I mean, at some point, this whole global warming scenario will affect global agricultural markets. If you look at wheat in the moment, trading at $4.50 a bushel, I mean, inflation adjusted, they nearly give it away compared to the price in the 70s and 80s. So there's an enormous value proposition with wheat. If someone cared to look at rough rice, it's a beautiful takeoff of 35% over the last 2-3 months. And they tend to sort of go in a simple cyclical sort of a price movement. Rough rice happens to be ahead of the pack. But all the grain markets, the supply story is really the big story, and that weighs on prices for the right reason. We just think from an investment point of view, this is extreme value, and investors and speculators should look at these markets now because the value is here. There's a bit of a contango issue if someone has to hold a position for longer and should be looked at. In other words, there's always a premium to be paid to roll positions over and onwards. But net, we think the value in grains is here tremendous, and any pullback should be used as an opportunity to go along these markets.
All right, fantastic, Markus. Always a pleasure talking to you. We appreciate your time. Thank you very much.
Thank you, Leanne.